Welcome to World Finance Brief. You know, for decades, the battle for an edge on Wall Street was all about humans. But there's a new player in the arena, one that doesn't sleep, doesn't feel emotion, and never, ever gets tired. It just processes data at lightning speed. Yep, we're talking about predictive AI. And in this explainer, we are going to decode how it's completely changing the game.
So, here's our game plan. First, we'll look at why AI is Wall Street's new weapon of choice. Then, we'll actually dissect an AI signal to see what makes it tick. After that, we'll check out the specific trading plays it cooks up, see how it thinks about different timeframes, and finally, we'll tackle the big one. Is this the end of human investing as we know it? Let's get into it.
All right, so how exactly are these machines finding an edge? Well, they're using these incredible predictive AI models to just sift through mountains of market data, spotting patterns that a human might totally miss. The goal? To generate trading signals that can beat the market and keep risk on a tight leash. To see this in action, we're going to look at a real-time analysis from the firm Stock Traders Daily. And for our case study, we're looking at something huge. It's one of the most widely held and watched funds on the planet, the S&P 500 ETF. You know it, ticker symbol SPY. By pulling apart an actual AI report on this massive fund, we can see exactly how this tech works, what it's looking for, and the kind of insights it's giving to traders right now. Okay, so to really get what the AI is telling us, we first have to learn to speak its language. You see, every single AI signal is built on a few core ideas from technical analysis. Let's start with two of the most important building blocks. First up is support. The easiest way to think about this is like a price floor. It's a level where the AI expects buyers to jump in and say, nope, not going any lower, stopping the price from falling any further. It's a potential zone of stability, maybe even where things turn around and start heading back up. And on the flip side, you've got resistance. If support is the floor, this is the ceiling. It's a price level where the AI predicts sellers are going to show up and cause a rally to hit the brakes, or maybe even reverse. It's basically a hurdle the price has to clear if it wants to keep climbing higher. And this right here, this is brilliant. It shows exactly how the AI uses these ideas. This is a direct quote from the analysis. The AI isn't just pointing out levels on a chart, it's building a story. It's saying, hey, listen up, we're at a critical floor right now. If the buyers can hold the line here, then the next mission is to go and challenge that ceiling. It's a dynamic if-then scenario.
Now, while the AI was looking at this whole support and resistance dynamic, it dug up a number that is just, well, it's an eye-popper. 13.4 to 1. What in the world does that mean? Well, let me tell you, this number is right at the heart of why so many big players are paying very close attention to this tech.
So, here's the bottom line. That 13.4 to 1 ratio, that's the risk versus the reward. The AI found a trading setup where it saw the chance for a 3.9% gain while only risking 0.3%. This is what's known as an asymmetrical bet, and honestly, it is the holy grail for traders. It's an opportunity where the potential win is just massively bigger than the potential loss. Finding a setup this lopsided is, wow, it's incredibly rare.
But here's the thing, the AI doesn't just spot an opportunity and call it a day. No way. It then translates all that data into concrete, actionable strategies. It actually builds 3 different trading plans, and each one is tailor-made for a different kind of person in the market. And what's so cool here is how the AI customizes its advice. For a long-term investor, it lays out a position trade, buying in with a really ambitious target in mind. For a more active trader, there's a momentum breakout play, which is all about capitalizing on a sudden burst in price. And for the more cautious folks, it even gives a risk hedging strategy, which is actually a bet that the price will fall to help protect a portfolio. And notice, for every single play, it gives you a precise entry point, a profit target, and a stop loss. That's your preset exit to keep any potential losses in check.
But wait. There's another layer of sophistication here. The AI's outlook isn't just one size fits all. Its opinion actually changes depending on the time horizon. So what it thinks is going to happen in the next few days can be totally different from its forecast for the next few weeks. And this shows that nuance perfectly. You see, in the near term, like the next 1 to 5 days, the AI signal is neutral. It's basically saying, hold on, be cautious. The path right ahead is a bit murky. But when it looks out over 20 days or more, the signal flips to strong. It sees a clear positive trend over the long haul. This is super helpful because it helps traders match their strategy to the right time frame. You know, maybe avoiding a short-term dip while still getting set up for a longer-term gain. So, let's zoom out and pull this all together. What does this technology really mean for the future of finance and for every single one of us as investors? Well, we are definitely moving past simple charts and gut feelings. We're stepping into an era of data-driven, probability-based decision-making. So let's recap the big benefits we've seen. AI gives us unemotional, data-driven signals, which takes fear and greed right out of the picture. It defines crystal clear risk management with those precise exit points. It delivers its analysis in real time, and, as we saw, it can shape different strategies for different investors. And the ultimate goal? To get alpha, that's returns that beat the market, while cutting down on beta, which is your overall market risk. And this, of course, brings us to the big provocative question. As this technology gets more and more powerful and easier to get your hands on, will it actually replace human financial advisors? I mean, does a machine that can calculate risk and reward like this make human judgment obsolete? Or is there still a role for human oversight, for setting goals, for coaching? It's a massive debate, and we really want to know what you think. Drop your opinion down in the comments below. And that's all the time we have for this deep dive into the world of AI trading. Hopefully this breakdown has given you a much clearer picture of how these machines are creating a whole new edge on Wall Street. Thanks so much for watching, and if you want more explainers that cut right through the noise, make sure you subscribe to the channel.